Hello, ACCT 2302 Managerial Accounting people. This is the end and the beginning. We are finishing up the class and the course. And this is your host to bring you all the end game, Professor Naragon. Welcome back. So, Chapter 24. This is all about capital budgeting and investment analysis, and we're really going to focus on three aspects of this in the maths terms as we go through. But we are going to go over a few things as we finish up the last bit of the chapter. So, Chapter 24 really starts with how capital budgeting process works. And with capital budgeting, usually it's all about submitting proposals, evaluating, and improving or rejecting. Kind of like how we want to look at how sports teams make a stadium. They're going to submit a proposal to the city. City's going to evaluate this proposal, see if it's going to be good for the taxpayers or whatnot. And then they're going to either approve or reject. If they reject, the sports team has to recorrect their proposal, submit a new one. If they approve, then we go on to perfect. But with all projects, there is risk. And we're going to figure out, is it going to be enough risk for us? Is it going to get us enough income? And that's something we're going to look at as accountants. We're going to want to look at see when we can pay it back, or when it makes us actual true profit, or how much does it actually do? Now, there's a lot of methods to deal with this, and we're going to mostly look at machines, acquisitions, and stuff like that. But we're also going to be basically just tearing it down to only a few of these methods. Again, in your cost accounting class, you probably will dive in a lot more. Some of this you'll even dive into a finance class. So I'll even zoom in a little bit more so you can see. Zoom out. So when we're looking at acquisitions though, okay, now this is how most really capital budget projects go and the cash flow process. And we're really going to be focusing on that. So this brings us back to chapter 23 when we had that whole should we buy a machine or should we keep with the old one. Same thing that's going on here. Basically, once we acquisition a machine, we buy a machine or anything like that, we have cash going out. That's a negative initial investment. Well, when we use it, we're going to have revenue coming in based on that machine. So that's going to be addition to what we can get. We're also going to have to subtract out operating costs, repairs and maintenance, so forth and so on that machine. Well, eventually we get to dispose the machine. And when we dispose it, we actually get more money in. So it increases our cash flow. That's a good visual thing. It's visual. Yay, visual. So that's a good way to see how the cash flow works in capital budgeting. We're just going to basically go into some of the methods we can do. And there's first method is known as the payback period. So let me zoom this in. So the payback period, which looks at the expected amount of time to recover the initial investment. And usually this is a good way to show how quickly can we pay this back and start making profit on it. So we're going to use this example. We're going to say this project cost us $20,000. We are expecting a cash flow of $5,100, and it's going to be for about 8 years. Cool, rock on. So how do we do this? We're going to follow this 5-step program again. 5 steps, just 5, not 4, not 6, 5. All right. So to do this, first you have to start with the cost. And it's always going to be negative because it's again an outward cash flow. Then we're going to add back the first year's cash flow. And we'll keep doing that until the remaining initial cost in the upcoming year, the cash flow is going to go over that. So once we reach that year, we're going to take the remaining cost and divide it by next year's cash flow. Okay, sounds a lot, but we're okay. Add up the years in step 3 and add your answer in step 4, and that will equal our payback period. So, of course, we're going to show you how this goes. In fact, I'll zoom in even more so you can see. Boom. So, here's it go. In our example, our initial cost of the machine was $20,000 as a negative. Our cash flows per year is $5,100. So, with that being said, to take 20,000 negative, add a positive, we're still with a negative 14,900. Okay, repeat the process. Year 2, add another 5,100. We find out that the remaining cost is now negative 9,800. Okay, still 5,100 will beat that. So in year 3, we put in 5,100, and we finally end up with a remaining initial cost of negative 4,700. Now, this is now below our cash flow. So this is where we end up have to take step 4. So with step 4, we're going to have to basically take the remaining year initial cost, 4,700, and divide it by our cash flow of 5,100. We find out that it is 92, basically 92% of that year, or 92 of that year, 0.92, that it will take us to finally recover the initial cost. So, using step 5, we finished year 3, so we got 3 years, and add the 0.92, so 3.92 years will be our payback. Now, this is very, very simple way, and most of the time accountants are going to use this just so that we can throw out a number and have a little math that goes with it. Unfortunately, being so simple, it does have its drawbacks. So, again, advantage, easy to use. Disadvantage over here is that it does not reflect timing differences in net cash flows. This one assumes cash flows is going to stay the same every year. It's not always the truth. It's not always the case. It also ignores all cash flows after. So it doesn't even tell us how much profit we're going to make after on. It just cares about when we pay it back. And also it's going to ignore time value money. So again, that's future value, present value. We're going to get into that later in this chapter. That's mostly method number 3. That's going to take the bulk of this chapter. Alright, let's zoom out because I just wanted to show you that chart a little bit easier. So the method number 2 is the counting rate of return that we can use to see if a capital project is good, bad, what we're going to make our decision based on. Now, this is basically taking our net income and our invested assets and determine how much of a rate of return that these assets are going to generate us. Basically, are they going to do really good for us, or are they going to do really bad? So, with this, it's going to have this formula. accounting rate of return equals to net income divided by average invested assets. So again, we're going to take an example. We're going to assume that a business is investing an asset of $100,000 for 4 years, and we'll have a salvage value of $24,000. So maybe it'll have a salvage value. We'll find out. So I'm going to zoom in just a little bit so you can see everything. Nope. Zoom out. Alright. So it has $24,000 at the end of the 4th year. The net income generated each year of the asset in use is $54,000. So we're going to calculate the accounting rate of return. But first, we're going to have to do the average invested assets. Now, since we're only looking at one machine and not multiple, we're going to take the average by taking the original cost of $100,000 plus its basically ending value, its salvage value of $24,000. So $100,000 plus $24,000, of course, is $124,000. Divide that by 2, because again we got 2 numbers right here, and we find out that the average invested asset is $62,000. Once we got that, we can now basically create our rate of return, which is $54,000 net income divided by that $62,000 we just did to equal out 87.10% of accounting rate of return. We've almost got a complete 100%, so that's really good. Yeah, but again, we have one significant problem with this. It's a good method. It's another easy, simple one that we tend to use, but it uses accrual accounting figures, in particularly net income. And net income has cash and non-cash items. So it really may not reflect the true value added from a capital project. This can throw off just a little bit because of those non-cash items. So again, it's a simple figure, simple method, just takes a little bit of a problem again using the accrual accounting figures. So 2 methods, 2 very simple ways of doing it. Both have its significant flaws. So we're going to land into the 3rd method, the big bad boy of this chapter. And this is time value of money. And this is really big finance. And again, you can do this in your finance class. You get the formulas. You have to figure out formulas. We're not going to do it. I'm going to warn you already. We're not going to do it. So we're just basically going to pack on what we need to know from this chapter. Okay? And how to do it, definitions and whatnot. So no worries, not doing something very complicated. And everybody just went, yay, no complications, woo. But we do have to know. And really, if you're a banker or worked at a credit union, worked at a bank at all, you kind of know some of these already, know the terms, but we're going to go through this. Okay? So we have 2 forms of interest. And one is known as the simple interest, where interest is basically calculated on the original, usually a fixed sum, and even if additional amounts are added, whether it's from the investor or from the interest itself, interest is still earned at the same each period. So it's not going to really help at all. It's basically taking your lump sum, interest, whatever rate that is, times your lump sum, and it's going to stay that way. This is basically how we would say bonds work. Bonds are very simple. Again, we've already figured that out when we did that, when you did 2301. chapter 10. Yeah, chapter 10. So if you want to go back to chapter 10, learn about bonds if you want to. But that's how it worked. The bond had one lump sum. We just times it by the interest, and we divided by how many periods we have, and that is what it is. That's a simple interest item. Compound interest, though, is interest basically being earned on top of interest. That's how they call it. But anyway, it basically takes the interest and it times it by however much is in that account, or whatever the amount is, and keeps creating larger and larger. This is where we end up adding more payments into it, so that the interest goes higher. This, you can, if you want to look at how you deal with a bank, this is like your savings account. If you ever seen your savings account, if you just leave money in there, well, it's going to take that original amount, times it by the interest, be it that 0.5% or 0.8%, however little that interest is. I know, not great. This is where you invest probably in a CD or something. But take that interest, it gets times. Then from there, it adds on to your total. Then next month, if you haven't done anything, it times it by the new total, the interest, and keeps going and grows and grows and grows, and it keeps getting larger and larger and larger. So when we're discussing our time value money principles, usually we're discussing it based on the compound interest, not usually on the simple one. So when we look at that, we're going to go mostly to a project they're going to end up generating positive cash flows. But again, we're going to analyze basically on two primary types of cash flows. One is our single sum or lump sum cash flows. And these cash flows occur only once during the project's life. Again, that's why they're single sum or lump sum. Only happens once. There are no additional payments or any other cash flows being earned or generated. So basically we take that one thing and calculate present value or future value, depending on which way we want to look at and how the interest has affected it. Number two is known as an annuity. Okay, so when we look at single sum, that's again just saying your savings account and you just throw in money and you never touch it again. An annuity is basically occurs when a series of payments are the same in size. So this is taking your savings account and or maybe an IRA, something that automatically gets pulled out of your paycheck, the same exact amount, and basically keeps getting put in to add on to the savings. Okay, so these are same in size, timing, and have a definite end. So of course they're going to last only for 5 years, 10 years, 30 years, whatever we want to go with. But something that constantly gets paid in. Okay. So to really see how this works, we're going to use an example. You knew we had to. You knew we had to. So in our example, we're going to suppose you just got $5,000 from a family inheritance. Yay! Rich Uncle Bob just passed on and gave you $5,000. Wasn't so rich, but we'd still call him Rich Uncle Bob. Yay, Uncle Bob! And you invested into your savings account that earns a whopping 3%. This is a great bank. If you can ever find a savings account for 3%, go for it. It's awesome. And you're curious, how much would this money be worth in 1 year? Well, we can use time value money to figure this out. So, we're going to do it. Yay! Yay, yay, yay. Yay, yay, yay. Yeah, yeah, yeah. So, normally, if we were in a finance class, you would have all this math and formulas. You would have to use a calculator and just to figure all this out. We ain't doing that. Nuh-uh. We can also use Excel and spreadsheets to make it easier. Nah, we're not going to do that either. We're going to make it simple. Again, we just want you to know the overview. So we're going to stick to tables. And in your Blackboard, if you actually go to your Blackboard, right in your course content, if it goes through your course content for me, may not. In fact, there it goes. So go to your lecture notes, and right here will be your time value money tables. It will download that, and it'll be a zip file, and it'll pop out these tables. We're going to look at a few of these. Okay. One, if it says anything due, which I think a couple of these do, we're not going to use. Okay. It's like present value of ordinary income due, these two, we're not going to use. We're just going to look at future value of the tables. I don't know why my Google Drive has this one, but we're just going to look at the PDF files. This one will not appear in yours. Don't worry about it. Okay? In fact, let me trash that. There we go. Okay, so back to the notes. Click up 23. So back to the notes, and we're going to look at present value of $1, and this will have you find what the single amount of money is worth today. Future value helps you find out if you invest today, what it's going to be worth in the future. Present value of ordinary annuity helps you find for annuity what it's worth today, or a series of payments. And future value, again, is a series of payments for a future point. So, for our example, since we want to know how much that I put in right now for $5,000, how much after 1 year with 3% interest, how much will it be worth? So first we got to go to our tables. So here's our tables. Since we're looking at future value of a single payment, we're going to go future value of a table. So here it is. And what we're going to look up here at the top, you're going to see the percentages. Starts at 1% and moves on. We're going to find 3%. 3%. Then on here, going down your table, you're going to find how many years we have. We have 1. So 1 year, 3%. It's going to be 1.03. Okay. So let's go back to the notes. So with that, once we find that rate, we're going to take that and multiply it. First off, there is an error in your notes. That should be 3%. Why that's 2%? I guess they were going for milk. They wanted 2% milk. Yeah. But anyway, 3%. So we take our principal, or the amount that we put in, times it by our rate that we figured from our table, and we find out that after 1 year, we should have $5,150 in our savings account. So, without doing anything, just let it sit, we just made $150 for a year. Says not bad. That's definitely not bad if it's a savings account, because usually you probably won't see that. But let's do it this way. Let's say instead of just putting that $5,000 in, we decide that our budget will allow us to put $5,000 in at the end of each year for 5 years. And that's still growing at 3%. So now, look at our Google Drive. Well, at your tables, looking at Google Drive for me, we're going to find future value of an annuity. So again, all these tables show you the big old complicated formula, but again, we're not going to focus on that. So again, we're going to look for our interest, 3%, and we're going to say 5 years. So 5 years is giving us this factor of 5.4684 that we have to multiply. Again, do not round. Times it by its actual rate that pops up. So, with this, 3% in 5. I put the wrong table. Did I do the... Oh, yeah, I did the wrong table. See? Watch out for this annuity due. Do not use the annuity due table. There we go. So only the ordinary annuity. Sorry, guys. My bad on that one. So 3%, 5 years, 5.3091. That's my bad. Again, watch out. Those two tables of annuity due do not use. It's only the ordinary annuity of $1. Alright. So, taking that rate, 5,000 times 5.3091 makes it $26,545.50 at the end of 5 years. So, making 5 payments of $5,000, which is $25,000, we end up generating about $1,545.50 just by compounding upon each other. Not bad, not bad at all. We make some money. Now, if we want to find present value, we're going to use those tables again in exactly the same way. So of course, let's jump to present value. Present value, So here's our present value. Now, we're going to use the example that we used in the payback. That took 4 years to pay back. So again, we have 20,000, 5,010, 8 years, and they want a rate of return on the project of 10%. So that's going to be treated as our interest. Okay? So again, we're just looking at single lump. But we're going to be basically taking that it is going to be single lump, cash one, but cash flows combined at the each year. So really, that cash flow makes it annuity. Again, yes, we have a lump sum of the initial cost, but we're not focused on that right now. We care about this amount. Okay? So, let's go to that one. Hopefully I pulled out the right table. Right table? This one. There we go. Ordinary annuity of $1. Again, if it says due up here at the table, top, do not use. Okay? So, 8%, no, 10%, 10% interest for 8 years. 8 years, 10% should be 5.33493. So, back to our notes. Is it? But again, I just want to show you how to do the tables. Yeah, work the mouth. The mouth doesn't want to talk. But so 5,100 is its cash flow. Times it by our rate, we find out that the present value based on the cash flows is 27,208. So if its initial cost of 20 grand, we subtract that from our cash flows, and we find out that 7,208 in net present value. And since it's such a big amount that, well, basically adds on to the value, this is where we know we should accept this project. Because one, we pay it off in basically 4 years, but also we're going to actually have a good value of 7,208 starting off. So it's actually worth more than what we're putting in the cost in. Alright. So, few things with time value money. Again, it really focuses on net income, cash flows. So it's taken, again, non-cash stuff. So to get more accurate, which we can, we really do just remove any non-cash items for the income figures. So that means if it's a revenue, just like we did back in chapter 12 at 2301 with cash flow statement, if it's a revenue, non-cash, gains, credit sales, AR basically, we need to subtract that out. If it's a non-cash expenditure, like any losses or depreciation, we need to add that back. Okay, so this is basically, we're going to find our actual cash flows in operations. But for us, that's one thing to go with. Here we have also another way, something that can also happen. Cash flows usually does not come correctly the same every year. We're assuming that. Well, let's do this. We find out that cash flows is going to be different for multiple years. We're basically predicting this. So, when it's going to be for different years, the cash flow is going to be different. We're going to treat these all as lump sums for that year. So, i.e., year 1 is going to be 1, year 2 would be 2, and we're going to find the cash flows for so on, and get the factors as we go. This is known as the uneven project cash flow. Uneven project cash flow. Uneven cash. So, with that, we're going to use this example. Here, again, we got a project that's $100,000. It's going to have initial cost. And the 3-year projection, because it's only going to last for 3 years, has as follows. Year 1 be $25,000. Year 2, $41,000. And year 3, $27,000. Okay, as you can see, different cash flows. They are going to require the project to return at least 11% of the initial investment. So, again, in our charts, we're now going to look at present value of $1, since we are going to treat these as lump sums. So with this, blow up. Here we go. So we're finding out that we want 11%, and with 11%, we're again going to treat these as each lump sums. So for 3 years, we're going to take year 1, times it by, oh, it won't let me highlight now. There we go. By 0.90090. Year 2 is 0.81162. And year 3 is going to be 0.73119. If this continues for multiple years, we keep going down the list. And each year gets its own little thing. So, here's the table right here. And then here's us doing the actual multiplication. So, let me actually zoom in so you can see this. So here's our table. Here we go. So year 1, 25,000 times its table factor of 0.90090 equals a present value of cash flows of 22,523. Year 2, doing the same thing using their factor, 33,276. And then year 3 is 19,742. So with that being said, the total present value is 75,541 at 11% rate. Okay? So for us, if we take 75,541, because it's always our cash flow first, minus 100,000, which was our initial cost, we find out that the net present value is a negative 24,459, which basically means if it's negative, do not accept this project. No, 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 no. Do not accept. No. So, management may want to extend it, the cash flows or something, if they're going to reproduce this basically project to someone, if they're going to pitch it. But right now, it's a no good. No, no. So, that is it, guys. You have completed the adventure. You have solved the puzzles. You have rode the train to the final stop. You have passed Hogwarts. I don't care how you want. You can do the it's over kind of thing. this is it, the last lecture video for Counting 2302. So, it has been a pleasure teaching y'all as this went. If y'all had fun, great, yay. If you have any questions, again, put it in the comments below. I am sure to get to y'all to answer them. But, again, you have finished the lecture videos. And this is Professor Naragon signing off for the last time. Good day.